me to go live in time. So we're going to do that, and then we're going to get started.
So many rules.
I know. And I'm not a good rule guy. All right, everyone. Glad to have you here today for the Exit Your Way Roundtable. We're out here live on LinkedIn. We're here in Remo. We're going to have what I think is going to be fun today. I hope that at least a few of you understand and enjoy it, because we're going to be talking about developing annual projections. We had a great conversation with a few people at the table there talking about Chris Arrington was talking about Gen Alpha Technologies a little bit. I mean, it is a cool solution. If people haven't seen it before, go check them out. Check out Gen Alpha Technologies. Good stuff. We got David Chrysler in here today from the Chrysler Club.
Welcome,
fellow Detroit guy. Andrew grew up there. Long history of being in Detroit. We got Brad, Ron, and if you're on LinkedIn listening to us, go ahead. Yep. Andrew's got to put on his Michigan hat because last week was a momentous occasion in the Michigan football history.
The most watched game of the year, short of the Super Bowl. The ratings came.
I watched it. Hey. I don't have a dog in the race, and I watched it.
Well,
but that's great.
10 years that monkey was on our back, so
yeah,
feels a little better now.
Yep. Well, then in Washington State we had a little victory. The Cougars beat the Huskies, which my family are Washington State graduates, and my son
is a Husky.
Yep. And my son was at the game. He was one of those people that broke the rules and stormed the field, but they had a good time of it. So
good for him.
Big football weekend, that's for sure.
Obviously, he's not a good rule guy either. Then,
no, not so much. Yeah, hey, Mom and Dad may have not been the best in that regards. Awesome. Well, we're going to talk today a little bit about developing annual projections. The last time we started, we were talking about your strategic plans, putting together strategic plans. Now we're going to see how those plans affect your numbers, how they affect your long-term, your next year, and really how they tie together into creating your financial projections that in January, and I know it seems like January is ways out, we're going through the financial projection part of this in this event, and in a couple of weeks we'll do the next one where we're going to finish the last half of our projections, and then in January we're going to show you how you take these projections and turn them into the weekly, what do we call them? Operations meeting, not production, but business improvement meetings to really ensure that your teams inside the business are moving towards your goals that you've laid out, because they've worked with you on these strategic, the strategic plans. So they're saying, hey, we're going to grow our sales. We got these things that we're going to do in the operations to, affect the efficiency. We're going to all the way through your business in the strategic plans. You've worked on these. Now we're going to take these plans and turn them into numbers. And then we're going to take those numbers and turn those into actions in January. And we're going to have some fun doing it. And well, fun in my world, because this is, I think it's fun, but I think it, not so much the fun part about it is, but when you are running a business, this is the way to truly get much, much closer, if not achieve your goals consistently. Andrew and I, we developed this stuff when we were working in investor-owned companies out of necessity. And if you've been, go ahead.
They made us do it.
Yeah. Well, and out of necessity too, because if you go into if you're in an investor-owned company or a public company and you go into a board meeting as the CEO or part of the executive team and you've missed the numbers significantly, it's not a good thing. I mean, it's just not. And so really this preparation is very beneficial, because what does it really help to enable? It enables helping you to achieve the goals that you've set out and achieve your goals. So it's not that we're just doing this to be doing it. We're doing it because it helps you achieve your goals, and it's proven that it does.
Yeah.
So Without further ado, we're going to get started on this, and we're going to share a presentation here, but we're going to be flipping back and forth between presentation and some spreadsheet stuff. Hey, if you got questions, just reach out to us after this. We can go through this kind of stuff. We can share the spreadsheet with you, anything like that we're running through, because it really is not that hard. Honestly, in about, if you can get your accounting people to help, they can do a lot of the back work that gets this ready. But overall, if you spend 4 to 6 hours on something like this, you've already done the strategic planning with your team. You spend 4 to 6 hours on developing these numbers out, you can really change the game and make your projections work. So, we got Nicole in the house too. All right. Well, we're going to get going here. I'm going to share a screen, and Andrew and I will get rolling. All right, here we are again, the old familiar. So this is what I always like to put in the front of these is the why. Because if we don't know why we're doing something, we should figure that out before we do it. And really, in this case, it's to give everyone direction. What are we going to do in January? What are we going to do in February? What are we going to do beyond? And hopefully at the end of the year, those actions that we're doing drive the results that we're going to be. And Andrew, how have you seen this help when you do this planning and really lay these things out?
Well, I think, the big question is why, and I get that a lot. When we work with small, medium businesses, many of them don't do this exercise. I think we got a feedback there, Damon. Do you hear that?
I'll mute mine. Go ahead.
Okay. But, like Damon said, publicly traded companies, they live and die on their projections, and they have earnings calls, those dreaded earnings calls every month, whether they hit or missed. When prices go up, people get bonuses. When they go down, people get fired. So we've been in that world. I don't think that's a great reason why to do it. But, if you don't go through the exercise of doing your projections and to understand where you're going, you may think you have it kind of in your head and you're looking ahead, but going through this exercise gets everybody else on the same page too, number one. And then, also you begin to realize too, when you lay it out in this fashion and really go through this exercise, you may not do things, you may be doing things that you didn't realize you were doing. Or decisions you were making when you really, sit down and you got to do some analyzing. And you don't need to be a statistician to do this kind of work. And this is kind of why we'll show you how we work on this. But it's a difficult and it's a little bit intimidating to go through this process. And I think that's one of the reasons that people don't do it.
Yeah, I agree, Andrew. And I like this picture because it's kind of like wandering in the desert without a compass, because you're and we can do this. There's a gazillion businesses that do this for the entire lifetime of the business. And hey, it's okay. But if you really want to track to a goal, we all know that you got to write those goals down. You got to move it. And this is no different other than taking that and putting it down on paper and turning it into reality. So we're going to get going quick. So, the annual projections are really there to showing the plan. We got to show everyone the plan. You got to know, as an executive in the business, the plan. Everybody that's going to be helping to execute on this plan has to understand the plan. And it's key to that. Yeah.
And I think there's, this isn't really just a financial exercise. Projections are, a crystal ball, but the financial aspect of it or the accounting aspect of it, you need that data. And I think that's where a lot of people miss in the planning because they don't look back. They're looking forward and they want to plan for that. They want to know what's in the next few months, but they don't look back and really, see how we did. When you're involved in a deal or a business or with your bankers, they're constantly looking at year over year. Why do they look at year over year? Because they're looking back to see how we did, in that same period the time before. and going forward. It's a very good thing to do in the plan, and it will
Yeah.
help you tune in your plan to make it reality.
Yep. And David says missing your numbers when you're working for a publicly traded company can make for some difficult conversations with a lot of additional explanation required. And that's the same thing if you're in an investor owned company, and it should be the same thing if you're in your own company as well, because you should be laying this out, because at the end of the day, this is what we're all looking at. What's our net income going to be for the year? I love this, because at the end of the day, what are we trying to figure out? How much money are we going to make next year? That's really what we're doing all this work for. We're putting all this together because, hey, we want to achieve these goals and we want to make this net income. So it's a fun little exercise. We're going to get started here, and we really, as we go through developing the annual projections, I see Kelly's in the house too. Kelly Robinson, great to see you. Thanks for being here. We're going to get going here now. So where to start? And I always like to start simple. And you pull up and I know these aren't current year monthly financials. This is something I pulled an image off, Google or something here, but print out your monthly financials like this. And if you got a halfway decent financial program on the backside of your company, you got this. You can print it out in the monthly format, because this is your starting point. See how you did. Reflect on that. Andrew, how many times do we do this when we're working with clients, to print out their year and look at it?
Yeah. And surprisingly, how many of them don't look at it this way too? But where you start is where you've come from. So I think the starting point, and where I typically, we work with clients to help them develop their projections, right? So that's an exercise, and it's good to get other people involved. Don't just do that yourself. Bring in your team, your sales team, even some outside people, to have a look at this, because, projections have to be challenged, and you have to defend them and understand them. But we look back, start with the historical trend. What have you done the last 3 years? Then what have you done the last year by month? See how it's going. You can forecast on just a straight numerical historical trend. Again, you don't need to be a statistician to do that. But if you go the way you have been over the last 3 years, then you start with, this is what it'll look like going forward on a historical trend basis.
Yeah.
That isn't always accurate. There's a lot more factors involved about maybe what's going to happen in the next 12 months or the next 24 months. And then we have when you analyze and look at the historical trend to start the exercise, then you really understand, well, how did that happen? Why is it repeatable? Is it going to do it again? And it starts all the discussion and the thought process to really understand, where you're going to go for the next 24 months.
Yep. So you're starting with these monthly financials. Andrew does this a lot in our business as the result of doing business valuations, where we need to project what the next years are based on historical stuff. We also do it with clients when we're doing this exact thing. We're actually with, I don't know, many clients right now doing it because this is the time of year that people come and do this. But it starts with looking at your historical stuff, getting it out in the monthly, because then we're going to take this and turn it into a projection template. This is not the one. This is a stock image, but we're going to talk about it because you got a projection template. You don't even realize it. It's that financial monthly financial Excel exports as you can do from your accounting software that gets you started. Now and I'll gladly share the template we're using here too, because it combines the tabs together, because what you want to do is take that and add other tabs to it. You want other tabs that are going to talk about direct costs, the sales, the staff, and other things like that we'll see. But this projection template becomes the heart of what you're doing, because you can see how changes on a monthly basis will affect the overall profitability for the year. So we're going to do something here. And then, so where do we start? We start again. We've got our historical, we've got our projection template, and we're going to look at 3 things first. We're going to look at sales, because we want to know what top line revenue is. And now that's a taking a look at that. And we're going to incorporate the strategic planning that you've done. You got your historical sales. And then we're going to go, okay, now this is what we put together in our last thing where we were talking about what are we going to do in sales for the year? What are you doing in Q1, Q2, Q3, Q4? And we're going to blend the two together. We're going to say last year, if we sold $1 million in the first month, in the second month, the third month, or whatever, what's changing? Have we added clients? Have we lost clients? What's changing in that? And what are we doing that's going to affect it positively, or what's really happened? So you can go through and you start with sales, because that's where everything starts in the business, is if you've got how much money is coming in. Now, Andrew, how hard is this for some people to really do?
It's the hardest thing. This is it. I mean, if you can, are you looking in a crystal ball and just throwing darts at the board on your projections? But if you can figure out the top line, if you can get, at least within a 10 plus or minus degree of accuracy on your sales part, all the costs, the fixed costs, the assets, the capital expenditures, and everything else, we can figure those out. So my focus typically when I'm working with clients is really spend the time on that top line projection. And again, I think that this is the hard part. And I get a lot of blank stares when I ask that question about what do you do? So we try to make it easier and try to understand, what are you going to do this week? What are you going to do by the end of the month? And then we're pretty highly confident. What's your level of confidence in that? And then what about at the end of the quarter? And then let's go out from there. Confidence decreases the further out you go, and that's natural. But then we come back and start asking questions, and that's what you really need to do in this exercise is do that too. But I think one of the reasons that people fail at this, and it is done badly often on forecast and budgeting, is because they go forward 6 months and then they realize how much they missed by.
Yeah. Well, and this is like, where
it's not, screw it. This is impossible.
Yeah.
Right. But that's where you turn your projections into your plan. And, it's not just, and then you've got to have different levels of projections. Some are more of a reach and some of them are static. And then your plan prepares you to, sort out what those costs are.
Yeah. Well, and this, when you're putting together, and David talks about being realistic about setting your sales projections, looking at the history, looking at what's going on, market conditions. And he talks about one of the things, David's here, that I want to make sure of too, as we're going into this. You got to have your sales team involved. Your sales team is going to commit to these numbers. They're going to commit to these increases. And you're going to sit at that table and you're going to say, listen, if you're going to raise sales by 5% next month, and that's going to carry through the rest of the year because of this effort, you're going to be held accountable for that.
Yeah. Well, and another aspect of it too is it really helps your sales team really focus in on what the goals are, and they're buy-in, right? So if you look back and you say, okay, we had 15% year-over-year growth from last year, but what happened? Okay, in July we added this new channel, and look, that's really attributed to that growth. And then you project forward into that too. We're going to add another channel. Once the sales teams realize the impact of that, right? Oh, wow, that's not that hard. And they're not going to spend all their time doing, low margin kind of busy work. Yeah. They're going to go, I'm going to get one of those new channels. Right. Yep. And yep.
And David mentions one other thing that we're going to show in just a second here, because we're going to go a little off road here, and we're going to switch what we're sharing. And I'm going to share another window here, because we're going to go into these projections, and we're actually going to start to look at this thing so that we can do this. Now, one of the things that we like to do in ours, and you can see we start our projections here with the planning tab. This is the planning tab that I was showing in there before. And these plans are in the same spreadsheet, so we can refer to them. But then and I keep going, I'm clicking on the tab in the damn projection, but in the presentation. But here we go. Here we have our sales by month. You look at this across the top, January through December. What are my sales? And this is a company that has e-commerce channels, direct sales channels, all this. You just go in here and you're going to say, okay, my sales for January is 100,000. And like Andrew and David both talked about. So what happens I'm going to do something in February. It's going to raise my sales by 4%, or I've got a new project that I know this customer is going to be increasing their sales because of different programs. You go through this with your major customers. Again, the 80-20 rule, you will get so darn close on this. If you do what David's suggesting, what Andrew talked about, you won't believe it if you do this, because I've seen people in $50 million companies spend 2 hours with their salespeople doing this, and they're people that are close to the customers, and get within 5% on 12 months. And if you do that, that is where you really get the power from this, because as everyone's talking about, you can then talk about all the other things that happen because of this and plan your business out because of it.
Yeah, and I think too, what you'll really find out is that's your resource right there. The salespeople, they know what's going on, right? So they have the answers to your question. Can we hit this target? Can we add that channel by
Yep.
first quarter? And listen, once they feel they're part of that process too, they're going to go out and own that.
Yeah. And this is what I always like, because when you get these people, and this is not just sales, this is your if you got production, operations, developers, whatever, this is where the rubber hits the road, because they're committing to this stuff. And you need to just remind them of that. It's like, listen, we know that you may not get it all the way we want you to, but we have to set the goals high enough so we really are going to have to put in our best effort to achieve them. But this is where the rubber hits the road, because if you say you're going to do $1 million in sales in a month, hit the $1 million. Do what it takes to hit that $1 million. So when we start to talk down the list, we've developed the sales. Now you really got to go, okay, what are my variable costs? And in companies where your variable costs are the major variable costs, there's really not much different when you look across companies. Is there, Andrew? When you look at the variable costs, they're pretty simple, and they are basically into 3 or 4 categories.
Yeah. But, like I said, you can back into those numbers and look back historically, go forward too. Your top line's changing. And the major indicator to look at is percentage of sales.
Yep.
Right. So sales go up, your variable costs are going to go up, and you need to be prepared for that too on a cash flow basis.
Yeah.
But because you need to be able to support that, you got to support sales, but you need to be really looking at those numbers and look at them as a percentage of sales, and then look outside. Go to benchmarking. There's services that can do that. There's people that can provide benchmarking data, and figure out too if your expenses are falling in line with your peers.
Yep.
Because you'll identify opportunities there. Because again, it's the net income line at the bottom where it all flushes out. So we're focused on the top line. We figure out what our fixed and variable costs are, but it's really how it affects the net income. So then that's the exercise. It's really understanding, what have I got to work with here on the budget side?
Yeah.
Going forward, if sales are here. So it's really imperative to get those top line numbers correct. They're as close as you can.
And you hit it, Andrew. Look at your historicals, because if your historical cost in materials, direct labor, sales costs, indirect labor, any of these, your indirect labor is not quite as variable. Some people, it's more of a variable cost, but we'll talk about that in a minute, and how we like to do it. And hey, I want to first of all say, we're not accountants. We're more functional people that deal with these numbers, blah, blah, can't talk. But you need to know what these variable costs are, because these are typically as a percentage of sales over the course of a year. This is what you're going to spend. Now, these are the major ones we've hit: material, labor, and your direct labor and your sales costs. But there could be other ones too, and we'll see those when we go in the next one. It could be your annual advertising spend or other things like that. So we're just talking about things that are generally above the gross margin line here now. And indirect labor is, I put it in here. It's not a variable cost, but it's usually above the gross margin line, or isn't, depending on the accountants who are doing it. But I did it in there for talking about that today. So we're going to quickly go off road again and I had to put these on because if you don't know what these motorcycles are, this is a BMW G1200 Adventure. It is the coolest motorcycle you can ever own. I'm just saying. So I know I'm a goofball, but if you're a motorcycle person, that's a one to have. Just go buy it if you're buying one. All right. So when we took it, now we're looking at sales. And again, this is a spreadsheet that has multiple tabs connected together. So if I make a change here in sales, it updates my profit and loss that, oh, magically my profit and loss, it'll update my income lines as I adjust my direct costs in here, which we're going to look at, or my variable costs. My variable costs that I was talking about in there are the materials, labor, sales, whatever you got. Adjust these things around, because if you know per sales channel, if you're doing kind of e-commerce things, if you know per customer, or just if all your stuff is the same, just set up one of these for your sales so that you can be adjusting this on an annual basis. Because if something happens in your materials or inflation, like now, last year in manufacturing, the price of raw materials just went through the roof, right? So are you including the effects of inflation and other things? That's a big one, isn't it, Andrew, this time?
It certainly is now. You always, I think that's just part of it, is you need to factor in some sort of, you have to have your assumptions, and you got to challenge those assumptions all the time too. So there should always be an escalation in expenses going forward, even a standard 3 to 5% straightforward escalation in expenses. And and this is an unusual year because we're probably past that. We're probably breaking your standard escalation costs.
Well, and some of these people are seeing 30% increase in raw materials. Well, what's that do to my 27%? Well, I got to go, what's 27% times 1.3, to get what my new percentage is going to be. And this is where you have to look at this in regards to your sales. My cost for materials or labor have gone up. Are my sales going up, or is it causing me to have a reduced gross margin? These are the things that, this is the part that really gets into, because below this line, this is where you generate the cash for the business. Because below the line, it's your fixed and the other stuff, that little bit of variable stuff. But we'll talk about that in the next one. But this is very important to spend the time to think about these things and these categories of your variable costs that will be doing that. And
this comes back to pricing. This is a pricing exercise.
Yeah, it is.
Once you lay this out and you can see what's going on here, you don't want to find out your pricing wasn't right.
Yes.
At the end of the year, you want to find that, you want to start looking at that too. And you may, they may be retiring some product lines and trying to develop new ones, moving around, so those decisions are made at the beginning, before it's too late.
Yeah. If your systems are good enough to give you this information by customer, that's awesome. By channel, it's incredible. And again, this is taking these numbers by these different channels. And what we're doing in this spreadsheet is we go down here and we calculate all the monthly based off the sales that we put in our sales by month. Well, I keep clicking on the wrong thing. Sorry. We click on these sales. If I change the sales in any one of these per month, it's changing my variable cost. These variable costs then update our profit and loss statement. So if my materials go up, then right here, my materials line will go up in the months like it should. This stuff is not hard for your accountants to set up, or, someone that's got that can do this for you. You get the people working together.
Well, one of the things to understand here, and this is quite important, is your accountants. This is not a bookkeeping function. This is a CFO function, which is, again, like Damon was talking about, where we have operational accountants, but small medium businesses generally trying to blend those two positions together.
Yeah.
Or typically, they don't really have the resources to have. CFOs are expensive, right? But these are something to look at, but you have to be able to do that. So make sure you understand that bookkeeper's function is just to report the score and help you set these things up and get you the data and keep the data up to date. But, as far as having them make strategic decisions or looking forward, as far as those kind of things go, you or your CFO and need to, your team need to work on that part together.
Yeah, and you if you don't, I mean, obviously in some businesses, if you don't have the CFO, it's going to be a combination of everyone. You may need some outside help to do a little bit of this, but the exercise in and of itself is great, because as you're doing this, and Kelly goes, is this Andrew and I's company? But no, this is a blend of like 100 companies, right? That we've done this before. So but as you're doing these things, and you're down over here, I'm going to the far side over here where we're looking at the 2022 total. What this does, all these changes that you're making to this goes again and goes, okay, I look at, this is my year total. And again, I'm looking at every single change I'm making. I'm coming back here and I'm looking at how does that affect my net profitability for the months themselves and the year in total. And this gives you're working through this, because as Andrew said, you don't want to get halfway through the year. Oh, the motorcycle pick, Nicole, that's motorcycle pick. Nope. That's the one I wanted. That's not the one I did get. But I'm getting a different one that I think is cool.
Christmas is coming, and he's been a good boy this year. So
yeah. Yep. No, I'm getting one that's a little different.
So yes, we talked about, we really worked hard on the forecast, the projections, looking in the crystal ball. We worked down the numbers, but the key word here that Damon is talking about is scrutinizing. Scrutinize your expenses line by line by line. Because yes, we changed that top number. Fixed variable costs change as a percentage of sales. Fixed costs are kind of what they are. Maybe they are. If you go down and scrutinize those lines, not only early, but then again on a regular basis, either it's monthly or at least quarterly at a minimum. And you look back at the history, you're going to identify opportunities. To reduce those expenses or do something different.
Yeah.
And that's scrutinize.
Exactly. And when we do this stuff, it's really about, you're talking with your team, you're asking if you got purchasing people, or the materials are going to change, or how your labor is going to change. You've got to, your new hires are costing you 25% more. That's another thing that's hitting every single company now, is the labor is costing more. But are you able to offset with you looking at your operations team? This is, again, like your strategic planning. You have to go through this with your team. Even if the team is you looking in the mirror, writing down the numbers, you got to go through this and really get comfortable with the fact that it is going to turn out that way. So I'm going to quit sharing this again. We're going back to the presentation, and that's where we're at with that. We're going to get through this quickly, because we will end up at, like we said, so we're coming back into this thing. So we're going down to that gross margin line on these. And if you gross profit, gross margin, there's different, I think margin's the percentage, isn't it, Andrew? And profit is actually the dollars or something. The actual thing, I don't know. I just know there's dollars.
There's all different words, but gross margin is after cost of goods.
Yeah.
Which is basically variable costs are mostly in
that
area. And then net income, is at the very bottom below all your administrative expenses.
Yeah.
But there's also, there is an outside little factor in here that people, often overlook in their budgeting exercises, is capital expenditures.
Yeah. We'll talk about that next week, because you got to understand how you're going to pay for what you're doing. And that doesn't necessarily come off of your profit and loss statement in your financials. So it's
a big dollar number often.
Yep. Off your total cash flow. That's for sure. So really what we're looking at here is again, we've got the sales at the top, and we're working our way down through the cost of goods, and we're getting here to our gross profit line, gross margin line, whatever you want to call it, because this is the cash you're generating every month to pay for all of your fixed costs, your executives, your every other thing that's not included in the variable cost of producing whatever it is, software, it just really doesn't matter what you've got in your variable costs or what you're producing. It's the same kind of thing. And when we look at this, so we're going to go down through here. Oh, we're getting close to the end. Woo! We're going to finish on time.
Promises.
Well, this is awesome, because what I wanted to do then
I
is,
think too, just quickly on gross, gross margin and net income. And, again, why do we do it this way? It's not just an accounting function, but, again, back to buyers, think about it from the buyer's perspective. They want to know what your profit margin is. That they're very interested in gross margin.
yeah, if you're getting ready to sell your business, this is something that everyone will be looking at. And honestly,
this is why this will, if you have this and you have this on paper and you have, you have old data that you've looked at, and you've new data and you've adjusted, and you're actually meeting your projections, the value of your company will go up, because this is the buyers. The first thing they're going to ask is, what do you think, what's the future like here in the next 12 months? If I buy this company, that's the first thing they're going to want to know.
Yeah. And especially if you're in that cycle of I'm going to be either preparing my company to sell or in the process of selling my company, having your annual projections and then meeting those projections is like gold. It's printing money for yourself when you're doing this. Mm-hmm. Even though you're years ahead of this, doing this gets you in the right frame of mind going through this. The first year you might be rough at it. I can guarantee you, if you do it a second year, you'll be better.
You will be.
You will be. Yeah, you will be rough at it. The second year, you will get much better. But when you look at this gross profit line and you really look at these things, and you notice that the different percentages, always look at your variable cost percentages and make sure, look at the big ones first. Like in this example, materials are my biggest cost. If I have a month where my materials is normally running at 28%, and for some month it's 35%, what the heck happened? Because that just dropped. Your gross margin is going to drop, or your materials and direct labor are the things that are biggest in this. Those are the key things that when we talk about that in January, we're going to talk about why it's so important to be tracking your cost side of this, to make sure that you're tracking to this on a weekly basis, because something like this, you can easily go 5, even 10% over on this on cost. Well, that's $40,000 or $50,000 a month on materials, and that you can do that. And if you're not tracking that and understanding what that is, before you know it, my margin won't be 35%. It'll be 27%. And when you look at your net income, my net income for that month, we were thinking it was going to be 12%. Well, that means now it's 4%. It changes the things an awful lot. Mm-hmm. So here we go. So we wrapped up at 8:45, Andrew.
Nice.
This is good. Well, I want to thank everyone for being here. Next time, so we've covered this down to the gross margin line. We're going to stop on LinkedIn Live, because what we want to do is we want to take some time with the people here in Remo and talk about it a little bit. We're going to stop sharing here, and we are going to be back in 2 weeks. We're going to finish this. What we're going to do is we're going to say, okay, now we've got the gross margin line. We know where we're at there. Now we're going to talk about your fixed and variable expenses, and looking at these things and how that affects how, again, as Andrew said, how scrutinizing and looking at each one of these and how they're going to change, and your overall indirect and your overhead labor as well, and some of the ways that we use to adjust it in that spreadsheet. Again, we're going to be looking in our projection spreadsheet again, and how that can help you get down to that net income for next year and really understanding it better. So, Andrew, final thoughts on getting your gross margin right?
This is the end of that's part 2 of the 3-part series. So
yep.
We'll just, this is it. This is, it's looking at the detail, looking back, what happened, going to happen, and to keep that cycle going. And you learn. Don't be intimidated by it. You're going to be off. Everybody does, but you get better and better at it. And if you can do this skill with your company, and like I said, get it within plus or minus 10% accuracy, you're going to add zeros to the value of your company.
Yeah. Yep. And I would say Mark Scrimenti on LinkedIn there, he's got some I've only got 2 screens. I need to get 3 or 4, I guess, so I can get more things going in here. But he was talking about the more you can demonstrate predictable profitability, the higher the value of your company is. That is 100%. If you can be doing this for 2 or 3 years in a row before you sell your company, it's like printing money. Because if you say you're growing 25% and you're tracking towards it and you've done that before, it is like printing money. They will believe it because you've proven it and you've shown exactly how it's being done.
So just like the stock market, they have to do their projections because you're buying the stock based on that. They do buy into future earnings, and if they make their targets and the stock just keeps going up, that's just how it works.
Yeah,
you can make it happen even if you're a small or medium business.
Yeah. Awesome. Thanks, Mark, for that on LinkedIn Live there. And the others that are listening, we will be back again in 2 weeks there. We're dropping back in here on Remo to talk to people that are in the room and finish up. Thanks, everyone.
Oops.